Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while practicing hot yoga. This is Through the Pines. On this episode, we explore the pre-retirement phase of life. So, when to start Medicare? How does Social Security work? Retirement distribution strategies. We cover these topics and more on this episode of Through the Pines. Our advisors this episode in the Banyan trailer with us from planwithbaxter.com. We have Rex Baxter, the Rex Baxter from Plan with Baxter, and Brandon Smith. Looking sharp today, gentlemen. Thanks for joining us here in the trailer. You might know them as the Forbes Best in State Wealth Management Teams for Utah, or the Advisor Hub Fastest Growing Advisors to Watch under $1 billion. And they are also the receivers of the Ameriprise Client Experience Award. That means they are good at their job. So thanks so much for joining us, Rex and Brandon. Let's dive right into what we mean, or what we're going to go through with pre-retirement phase of life. Does that start after the minute you're born, Brandon? That's
Technically, yes.
Technically, yes. Okay.
Yeah.
Just wanted to make sure.
Yeah.
But I think we have this, we said about 5 to 10 years out, I think is what we want to do today.
Yeah, and that's just kind of a rough idea. But
Okay.
yeah, as you start approaching retirement, because we had our last podcast on the accumulation phase. And accumulations, as you're growing and just saving and building towards retirement. But there comes a shift, right? When you go from, hey, I'm just trying to save as much as I can, enjoy life, but save, to where you're like, holy cow, here comes retirement, right? It's time to get serious. It's time to understand how that transition is going to happen. And so today we wanted to go through those things on what things should you be considering, as well as cover a couple topics that without doubt people have questions on as they get ready to retire.
Okay. So we will start with Medicare. When can I start Medicare?
65 is the age. And so, and I always recommend that someone, when you get that, get there, Rex and I, we don't do Medicare. We know enough to be, dangerous, but enough to, I guess, push you in the right direction. But you should probably work with a Medicare professional, someone who is, independent, able to represent, the various companies and help you understand what options you have.
Where do I find a Medicare professional? Because I see people have, say, for instance, a financial business or an insurance business, but I don't necessarily see signs everywhere for Medicare business professionals. Are they out there everywhere?
Yeah, they're absolutely out there. And we have a few that we like to recommend and work with. I'd say when you're looking for a Medicare professional, make sure that they're able to offer a full suite of different options. And make sure that they're able to explain it well to you. There's unfortunately not a lot of credentialing and licensing that goes into Medicare. It's fairly easy to get into. And so yeah.
Just writing that down so I can have a side hustle.
Yeah.
I find it interesting that some of the specialists that work on Medicare, it's just like in investments and financial planning, that sometimes you'll have somebody that says, "Oh, I'm an expert, right? And I'm an independent," but really all they're doing is working on the Medicare Advantage plans, and they're not working on traditional Medicare Part B, C, and D, and the different plans within Part B, as far as that's concerned. And so I think when you're looking for somebody that specializes in Medicare, that's one of the questions I think you want to ask is do they handle all aspects? Meaning, will they look at both traditional as well as the Advantage plans, help you compare and contrast the two, look at your prescriptions, look at your doctors, and look at what those needs might be over the next 12 months. Keeping in mind that every year there is an open enrollment period. Every year you have the ability to change. However, typically once you change, then lots of times the plan that you're leaving may not be available in the future. And so you do want to make sure that when you're making a change that you're really evaluating that well.
Okay.
And that they can cover the vastness of Medicare, but they're also not stepping way far outside their sandbox. And they're also offering your home insurance, your auto insurance, your financial planning. I mean,
podcast editing skills.
Right. Yeah. Maybe. You
Hot
really
yoga.
Yeah. Hot yoga. You don't know.
You want someone who's focused in and that's what they're doing. Health insurance, Medicare, that is their world. That's what they live, eat, breathe. But they're also able to cover the breadth of that topic.
Okay. Very good. Social Security. When can I file for Social Security?
We get a lot of questions on Social Security. So the earliest you can file is age 62. unless you're a widow or widower, then you can actually file as soon as age 60.
What, widow or remarried?
Depends on your age, actually.
Okay.
Yeah, really good question. So if you're younger than 60 and you remarry, that actually changes what you're eligible for in benefits. After age 60, you can actually remarry. But there's a few things to consider, right? Even though you're 62, if you're still working, it makes it really hard to get benefits. There's penalties involved. In fact, Social Security, they call it double dipping. And the entire objective of these double dipping rules is to make it so that if you're working prior to your full retirement age, which is typically between 66 and age 67, then you can't also take a regular benefit. So what they do is anything you make above this year's limit is $21,240. So anything above that $21,000, you're penalized $1 for every $2 that you make.
Okay, so I doubt Rip Charlie Munger. So I doubt he was taking Social Security. I don't know.
Why would you think he wouldn't be taking?
I don't know.
Security?
I don't, because does he need it? I don't know. But that's my question is, I mean, was he technically working? Because he was technically working until 99, essentially.
Yeah. So he was absolutely working.
Right.
He was a smart man. And so Charlie, he'd been an attorney for a long time, and then had been associated with Warren for a long time as well through Berkshire Hathaway. And I don't remember the age. There's a book. He has a book out, and I don't remember the age that he retired from being an attorney. But I'm highly confident that he took Social Security because he could, right? And if he's anything, he's a capitalist at heart. And if the government's going to sit there and say, hey, here's your benefit, here's your money, I'm sure he probably took that. Now, he may have turned around and given it away. He may have turned around and invested it. Who knows? But yeah, I'm highly confident that he was taking Social Security.
But would have waited until his full retirement age.
I don't know. He would have waited until either his full retirement age if he was still working as an attorney.
Right.
If and even through I don't know what his financial situation was with Berkshire Hathaway, as far as if he was, like
an employee,
a W-2 employee, or if he was getting 1099, or, I don't know what that situation was. And that can impact however that situation is, whether your benefits are being reduced by $1 for every $2 that you make over the earnings limit.
Interesting.
So, anyway.
Yeah, but traditional W-2 work, if you're making over that $21,240, you do the math on that, your benefit gets eaten up really, really quickly. And so, yeah, so that penalty's there. And so really, I guess the short answer is, when can I file and when can I take Social Security? It's either age 62 or whenever you retire, whichever is later.
Okay. Okay. When is my Social Security taxed? Up to?
Depends on your earnings. And this is actually done. So penalties are done on an individual level, but the taxes are done on however you're filing taxes, right? So if you're single, then obviously it's just you. If you're married filing jointly, it comes down to your household income. And so there are different phases, and these are kind of interesting. You've got, so if you, and I'm just going to throw some numbers out, and these unfortunately have not been indexed for inflation. And so they used to be really, really high, so it wouldn't really impact very many people. Now almost everybody hits this. And so married filing jointly, if you make less than $32,000, then you actually, your Social Security is tax-free. So that's really nice. If you make more than 32 but less than 44, then it's half of it is taxable, not taxed away.
Okay, wait.
But half goes to the tax.
What do you mean make? So is this like because you're drawing down from retirement plus Social Security plus maybe you're working a job? Like what is because the Social Security itself isn't taxed. That income isn't taxed, right? Or it is.
So that's in the calculation. And that actually is somewhat complex. So you take your Social Security earnings. Let's say you're receiving $20,000 of Social Security earnings. You take that, divide it by 2, and that's part of the calculation. Then you add that to other income. So other W-2 income, distributions from IRAs, not Roth IRAs, but traditional IRAs.
Oh, right.
Would count as income. And there are a few things on there that can run that income. But yeah, that's how you go in. That's how you calculate in this bracket what is taxable. And then from there, you determine how much of your Social Security is taxable. Is it 50%, 0, 50%, or 85% taxable?
Okay. Interesting.
We are not CPAs. I just feel like we should have a quick.
That's true.
Right there.
Absolutely
that's true. But there are also
But
rules that are public, right? So these are the public rules that are on the books.
There are.
So,
and we do understand those rules, and we do need to make sure that our clients and the public understand that, because there is a common misconception that Social Security is all taxed. And the reality is it's not all taxed. Only part of it runs through your tax bracket. The question becomes, is it 50% or 85% that's running through your tax bracket? And then on top of that, you have state taxes. And depending upon which state you live in will depend upon how they view Social Security. And so in a state like Utah, Utah taxes Social Security currently. It's under review. And so our Congress is looking at that to try and decide if they want to make that tax-free income as far as Social Security. It's such as in states like Florida, right, where they don't tax Social Security for state tax purposes.
Oh, I wonder why so many retired people live there.
I wonder.
Yeah. Huh. Okay. Okay. And then Social Security spousal benefits. When can a spouse file for benefits? When do they stop growing? What is that? The spouse probably stopped growing around 17, 18 years old. Can I receive spousal benefits if I'm not married? Okay. Let's talk about the spousal benefits.
Yeah. So a lot of good topics there. So you can espouse, and this is something I've seen this actually a couple times where people didn't know that they could file on their spousal benefit while the spouse was still alive. Example, I've literally seen this twice where a spouse was like, I raised the kids. I didn't really have a work earnings history. They got their Social Security statement. And it said, you don't qualify for benefits yet. And so they just didn't do anything, even though they were married to a spouse who had a full earnings record. Well, had they known, they could have gone to Social Security, said, hey, we're married, and qualified for up to half of that spouse's full retirement age benefit, which, could be $1,000, $1,500 a month, and just missed it. Just didn't file. Found out later, right? We talked to them like, holy cow, you need to file for this. And unfortunately, Social Security, they go back 10 years and pay no, right? They go.
So they don't give you a heads up, obviously, either. Like they don't send a letter out saying, hey, by the way, you might qualify.
Not always. Sometimes, right? Like it depends on the event. Sometimes they'll notify you, but not always. And so it's up to the individuals to understand, what Social Security benefits they qualify for.
Okay. Yeah, typically they don't notify you, but if you do go in and schedule an appointment with the Social Security Administration office or call in, then a lot of the representatives at this point are asking some of those questions, such as, have you been married before? Are you divorced? And how long were you married? When did you get remarried? And so that they can kind of help you along that way. I mean, they really want to help. Some just have more experience of doing that than others.
Right.
So,
and you don't need to be actively married to get a spousal benefit. In fact, if you had one person who was married to 5 other individuals, at least as long as each of those individuals had a 10-year marriage, each of those other individuals could file on that one single person's benefit. And it's not impacting anybody else's benefits. And so it's something to make sure that you're aware of. The other thing too is once that original, the one spouse passes, then all those surviving spouses' benefits go up. And so, yeah, kind of a lot of information there. One of the benefits of working with an advisor is so that we can go through it, because there's so many different little caveats and trails to go down. But yeah, so Social Security, if you're married 10 years or were married 10 years, you didn't get remarried, before 60, those are some things to make sure you pay attention to.
And this is, again, just to bring it back to the topic of the podcast, you should think about these things about 5 to 10 years. So you can meet with these, you don't have to meet with these people right when you turn 65 or whatever. Like you can think about these things prior to.
Yeah, hopefully we do.
Yeah, I think it's good to start having these questions and having these discussions when you're starting to enter into your 50s, right? So that you have enough time to research and think about it and look at different, possibilities, such as, should I work past 62? Should I retire then? Should I work till 65? Should I go part-time when I'm 62 and stay under that earnings limit and take Social Security? What do I want? And kind of go through those different scenarios. So
what happens if one partner is 65 and the other partner is 35?
Well, they have names for that, which I won't repeat on the podcast.
Saying happens.
Yeah, so it's I mean you still have your own earnings benefit, right? And so the older person will file when they hit full retirement age. The younger, when they get to 62, in a 30-year age difference, right? Their husband's 92 or their wife is 92, depending upon which direction that went. And so chances are they're going to be, filing early. That would be the odds.
Okay.
So I don't know. We'd have to look at that.
You don't see that a lot in your practice.
We see it on occasions. Maybe not that big of an age spread, but we definitely
10
see
to 15.
Yeah,
maybe.
we definitely see 10 to 15 on a fairly regular basis.
Yeah.
Right. Also, the spousal benefit stops growing at age 67. So a spouse can take it as early as age 62, but it's a reduced benefit. So the 50% benefit is then further reduced. And so that they can delay taking it until their full retirement age, 66 or 67, and take up to 50% of the spousal benefit. But after that, it stops growing. So if they wait till 68 or 69 or 70, there's really no benefit to that. And so you want to make sure that spousal benefits are taken prior to them hitting their full or at their full retirement age.
Okay, let's talk distribution strategies and needs. How can I figure out how much I'll need and when I will need it? What is the math equation? I'm sure it's a simple one.
That's funny. Yeah, that's very unique for everybody, right? It's a matter of running through cash flows and projected cash flows.
I mean, AI will do it for me, so I don't even know.
And AI is I found AI on the internet, and so it's got to be true.
It's going to be true. Yeah, and they know you personally, right? So if you type in Rex
did.
Rex at planwithbaxter.com, it'll know. Okay.
Yeah, it called me a nickname.
Oh, wow. You're ahead.
So I enjoy, because our 401k plans, right, they all have these little cute AI, it's probably not AI, but it's just cute algorithms, right, that say, hey, you're going to retire on this much, right? If you, based on your savings and based on this. And it's fun to go in and actually read what those assumptions are, because they're all over the place, right? And you can't blame it, because, man, what was your earnings history? Does it really know? Of course it doesn't. It's just taking your payroll number, right? And so there's a lot of different things that go into it. But like Rex said, chiefly the most important thing is understanding it's all relative, right? I get asked all the time, well, how much should I have for retirement? Answer is, it just depends, right? Like, I've literally seen.
Okay, so what's the first question you ask somebody then? Like how do you get to how much they're going to need?
That's great. Yeah. So really our first appointment, we're collecting all of the information. Cause to your point, we don't know, right? Like, I can't look at you and look at your statement and be like, yeah, let's do, it just, it's not that easy. And so we'll sit down with someone, we'll say, all right, what do we need? What's your house worth? How much payment do you have? How long will that payment go? Is that going to go into retirement deeply, or will it be paid off soon? How much debt do you have? Where's your savings at? All of these questions we will literally go through. We'll be able to calculate their net worth. We'll be able to look at where income is coming from and where income is going. And once we gather those bearings, then we can understand and say, all right, if you are living on an after-tax $6,000 or $8,000, whatever the dollars per month, and we can take that number, project it, adjust it for inflation, and then we can start to really make some recommendations. Then we can decide how much are we pulling out of retirement accounts, when do we need it pulled out of retirement accounts, and that's when all the magic really happens.
Yeah, that first meeting is really a discovery meeting, right? To where we're trying to build out a balance sheet, trying to figure out what you own, where you own it, how it's titled. We're trying to figure out what you owe, who you owe it to, how long you're going to owe it, and then we kind of back into what we think you're spending. Is how we end up doing that. And so, once we get to that point, then we can start projecting things out. And when we get to distributions, when it we're looking at retirement, whatever age that may be for you, then we're trying to figure out, where's the most tax efficient place to pull that from, and does it make more sense to pull and pay taxes at this point? Does it not? And so that's where we're going through those different decisions as we're going through. But typically when we're reaching this pre-retirement stage, when you're 50, we're projecting this out to when you're 100, right? And so we're looking at that even in your early 50s, as to what that distribution is going to look like and where it's going to come from, so that when it does come to that retirement, because retirement's a scary thing for a lot of people, and we want you to be really confident in your decision as far as when you have the ability to retire. And so, I mean, to us, retirement means the flexibility or financial freedom, as you've coined it in the past, having the ability to make that decision of, do I want to continue to work or don't I?
I saw an argument online, and if you know, you know. Okay, that's all I'll say. And the argument was over what is the appropriate percentage that you should draw from your retirement each year. And so it was probably based on what the average annual interest is, correct? Like what you guys probably use 8% or something. And so the idea is that, well, you can draw down 6% and be fine. And then this was a big deal online. Like people were fighting over this. And so do you guys have opinions on what the drawdown percentage should be around?
Yeah, we always have opinions.
Yeah, okay. Oh, I know. That's why you're here.
Yeah. People get fiery. People get hot, right? They have their strong opinions on that, and I think it really depends on what your goal is, right? We have some clients, we've talked about this in the past, to where their goal is to bounce that last check, right?
Yeah.
And so if somebody has the goal of not necessarily passing on a lot of money, then they probably can handle a slightly higher distribution rate. And so is that 4% or 5%, or where does that go? And what is your risk tolerance? How flexible are you in being able to tone down that percentage if we get into an extremely negative economic cycle that impacts the markets and your holdings? If you have the flexibility to turn that down, then you might be able to turn it back up during different times, throughout your retirement. Whereas other people say, well, I really want to be able to pass on some of this, and I'm more conservative, and I don't ever want to risk the chance of outliving my money. And if you don't want to outlive your money, then we need to make sure that the distribution rate is lower than your growth rate minus inflation and taxes, right? Because otherwise you're going to be going backwards, and you're going to run that risk of running out of money. And so those are all calculations that we end up running through and going through different scenarios, to where we say, well, what happens if you take an extra $500? What happens if you take, an extra 1%? This is what that looks like, right? Or what if you do that for the first 5 years of your retirement and turn it off, which can be really, really dangerous, because then you get accustomed to having that, right? And it's funny, people think that they're really, really mental giants and that they're strong enough to handle that. And let me just be the first to tell you, you're probably not.
Wait, we're not. Yeah.
I think there's some other confusion too, because you see financial products out there that will advertise like, hey, we can give you a 6% distribution rate on your money, which is far greater than 4%. But what you don't realize is that most times those calculations, they're not adjusting for inflation. So it's 6% on today's rate, and that's going to be a flat flat distribution for the rest of your life. So 30 years from now, inflation is doubled, right? Or cut in half the value of the dollar. And all of a sudden, that.
So wait, what's the 6% based on? It's not based on, I thought it was based on the, 6% of your the money that you have in savings.
So typically the argument is 4% is the big number, right? Okay. There were studies after study that said, hey, if you do 4%, that you're going to be set. And the assumptions behind the 4% are that, let's say for easy numbers, let's say you got $1 million, right? And you take a 4% distribution, that's $40,000 per year. The assumption is then the next year, that amount will grow. You take 4% out, the markets will grow more than 4%. You take 4% again, but it's adjusted higher for inflation. So rather than 40,000 next year, you're actually taking 41 or 42,000. And then the year after that, 42 or 43, right? And it's just adjusting with inflation. And so, 4% historically, if you look in finance 101 textbooks, that's like the 4%. But then you get all these financial products that come in like, we'll give you 6%, right? So if you got $1 million, we'll give you $60,000 a year, but never adjust it for inflation. Well, that's great. The first, decade.
To confuse that even further, when a lot of products out there, you have to be really careful what products you're using, is sometimes that 6% distribution rate is a distribution, right? That's not income, it's a distribution. So part of that may be your principal. So part of that distribution is interest, and part of that may be principal, which means that your principal is depleting year after year after year on certain products. And so there's actually a lot of issues. I saw one to where the president is looking at trying to implement additional fiduciary rules and guidance and things like that, specifically around some insurance products, that as far as the terminology and how those are worded and how people can kind of leverage those. So
and not get duped. Okay, so this is good. Allocation. So how do I know what to invest in as I approach retirement?
Different for everyone, right? And I like to tell people that there's two main risk factors that we like to take into consideration. First is the plan risk, right? So let's take your emotions out of it. What can your plan handle? How much risk can we take? And when I say how much risk, I mean like how much can we have exposed to like the stock market, right? And why do we want to expose the stock market? Well, historically speaking, that's grown faster than most other asset classes. And so we like to invest, have more in that. But there's a certain amount, would we ever say, hey, let's just put it all in the stock market because that's gotten the best return? At first it sounds right. But the problem is that when the stock market crashes, you still need to take distributions. You still need to be able to live. You still need to be able to fund Christmas, right? You need to do all these things. And so we've got to build your plan such that we've got backup assets, right? Assets that aren't going to be as volatile that we can draw on during down markets. And so, so the first is how much risk can your plan take versus safety? And then the second one is your guts, right? How much can you take emotionally? Your plan might be just fine. I've seen this plenty of times, right? Where people are in a panic and I'm like, this is fine. This works out. And this is how it works out, right? There's no way that we can't get through this. But emotionally, they're like, I just can't, like the numbers, right? I can't watch my statement, see my hard-earned dollars moving around. And so for those clients, you need to be a little bit more safe, right? Even though their plan could take it, they emotionally don't want that ride. And so what, we can work around that. The problem is we don't get as much rate of return, right? Which means we can't, distribute as much in retirement. We just need to get into safer assets that don't give as high rate of return, but also in exchange don't have that volatility. So those are two main ones: plan risk versus emotional risk.
Okay. Rex?
I agree.
No,
so I think that's right on. And I think that, we were talking before we went live about one of our other podcasts, Money Mind Games, and talking about the psychology of money and talking about, how people act and react. But one of the most dangerous things that you can do is look at a plan and somebody's out there projecting 7, 8, 9% rates of return over your lifetime and not really going through what the risk of that looks like, and running into a 2008 kind of an event to where the market's down 40%, your accounts are down 30, and you dealing with the emotional dynamics of that and panicking and making the exact wrong decision at the wrong time and selling out. And then you've really just kind of blown up the entire financial plan. And because you're not going to be able to recover, and because you're not going to be able to recover, then you're dealing with a smaller asset base to base that income stream off of. And so it's going to have long lasting repercussions. And so one of the most dangerous things is to go into this and only look at one of the types of risk, which is plan risk, and say, okay, my plan makes it, I'm good. And ignoring the emotional risk. I think they're equally weighted risks. Don't ignore one for the benefit of the other. Make sure that you're running through both.
Brandon, some more numbers.
Yeah, so I like these stats for two reasons. First of all, I think it's interesting. Second of all, it shows how easily manipulated stats can be. So this is actually the Financial Times put this out and said commercial real estate loans that are past due in the U.S. jumped 30% in the third quarter. I mean, and so Bank Reg Data actually had the main stats. That sounds terrifying, right? What? Commercial real estate loans past due jump 30? That means like all these commercial spaces, 30% more are past due. Right? Like that's is the economy coming to an end? It's not a good sign. But then at the end of it, they put, despite the rise, just 1.5% of commercial property loans were past due. So like it's up 30%, but it's still sitting at 1.5% are actually delinquent
of the total
of all of
Okay.
the loans,
Okay.
right? And so it's kind of one that I get that all the time. People are like, oh, credit card debt is higher than it's ever been. Well, that's true. But, relative, if you look at the charts, the graphs relative to income, it's actually in a really healthy spot.
Mm.
And so anyway, I thought that was kind of it'll be
Yeah,
interesting.
stats can scare you.
Yeah.
If you don't get the full picture there. Interesting. Did we talk about maximizing tax brackets yet?
No.
That's actually Roth conversion strategies. I think I
Hey,
skipped
kind of
over
the
there.
same thing.
Okay. All
They
right.
go hand in hand.
Hand in
right
hand.
there.
All right.
Hand in hand.
Let's do that then.
So sticking with our phases, right? And as you approach retirement, and this is probably one that we might see also pop up in just post-retirement or retirement. But you want to make sure that you're taking advantage of full tax brackets. And so what we can do, and it's really, really neat. Let's say you've got a bunch of money in your 401k. And let's say, this year you're married filing jointly. Let's just say you're making $100,000. And the threshold before you go into the 22, and there's some variance to it, right? But the threshold before you hit the 22% bracket is, let's call it 117,000, roughly. That's about where it is for 2023. And you're making 100,000, we can convert 17,000 and stay in the 12% bracket. And we convert that over to Roth. We have to pay taxes on that, but then it's completely tax-free and gross tax-free for the rest of your life.
Mm-hmm.
And so that can be an incredibly powerful strategy. Now, some people get way excited and they're like, I'm going to convert all, but it ultimately comes down to what's our marginal tax bracket now, right? And we can help people calculate that. And where do we think you'll be tax bracket wise in the future? So if you're pre-retirement, I see all the time people in their 50s like getting all excited about a Roth IRA, and I can clearly see they're in the highest tax bracket they're ever going to be in their whole life, right? You don't know what Congress is going to do, but it kind of seems like it, right? You can look, and they're getting excited about Roth. And I'm like, why wouldn't we just defer the tax, right? And do a pre-tax contribution and pay taxes when we're in a lower bracket in retirement?
Wait, do taxes ever go down?
Yeah.
They did. They went down for some people, they went down in 2016, right?
See? Okay.
And now at the end of 2025, they
might jump up.
They might jump right back up. But yeah, tax brackets will change over time, right? So coming out of World War II, back in 1950 or 51, the top tax bracket was like 91%, 92% was the top tax bracket. Today's top tax bracket is 37%. So do they ever come? Well, they went from 92 to 37. That's a pretty big drop as far as brackets. So, Congress does play around with that fairly frequently and kind of mess around with deductions. What can we deduct? What can't we deduct? And what are the caps and limits? And so that's why we work so closely with the CPA, because, I know enough to try and make sure we ask the right questions, but that's not my lane, right? And my lane is investments and financial planning and working down those lanes, not the accounting. So we'll work very closely with the CPA to say, okay, this is where we think the marginal bracket is. Can you confirm? Once you confirm, great. We think we have X amount of room in order to, do a Roth conversion. Do you agree? They'll look at it. No, you're wrong. You've got an extra 5 or shorten that by 5 because it's a little too tight. And we'll kind of have those discussions.
And I can't tell you how many of those conversations I've started, but I don't know that I've ever had an accountant call me and be like, hey, Brandon, I've been thinking about, right? Like accountants typically are so focused on, and I'm not hating on accountants, but oftentimes they're so focused on trying to get the best tax return today and get the most money back today that they don't pull back and look at the full picture and project out what a client's going to do in 10 years. And so that's where having a good financial advisor, we can flag, like Rex said, we can flag these things and say, hey, this is something we should consider. And then we work in tandem with an accountant to calculate that. One other point, you say tax brackets don't go down, and sometimes they do, sometimes they don't, but individual situations absolutely change. And you might have a year where one spouse retires or takes a hiatus to take care of a loved one or whatever it is, and all of a sudden your income goes from these high levels, and we have 1 year or 2 years where it's low. Man, that's a perfect time to really lock in those lower tax brackets, maximize those, and then move forward.
Rex, you mentioned that laws change, and so what are the risks on distribution during retirement that, say, you've started taking a Social Security distribution or a Roth distribution, and then Congress goes and changes a law, will that affect in real time your distributions? Like are any, in other words, is anything grandfathered in? Which ones are subject to change? How does that work?
Yeah, it's fairly rare for it to have an immediate impact or a retroactive impact back to the first of the year, typically. Most of the time, and it's not always, but most of the time, Congress will make those kinds of changes be effective for the following tax year, or they may grandfather certain people in. A lot of people are afraid that at some point they're going to begin taxing Roth IRAs again, which would be double taxation, which I think is highly, highly unlikely. And so, but that's one of the fears that people have. And so, I think the thing that they could do at some point, and I don't think they will, but the thing that they could do at some point is they could say, okay, we're closing this program down. Any earnings from this date forward, and they would put some date 5 years out in the future, we'll have to start paying this, wealth tax or something else, right? Something to where they're taxing some of the growth at some stage. Again, highly, highly unlikely that ever gets passed.
I'm sure they're looking at that and like, do you know how much money we're missing out on taxes on this Roth IRA?
Well, but at the same time, there's very few congressmen and senators that don't have Roth IRAs.
There we go.
So I'm not saying that there's any self-dealing there, but my guess is
that they're self-voting for sure.
Yeah.
I mean, you could like, well, I don't know. Do I want to harm myself with this vote? Like,
right. I voted for myself. Right.
Yeah. There you go.
So,
yeah.
Very interesting. Okay. So, do you want to touch on annuities, Brandon?
We kind of did.
Okay.
I guess just at a high level, I think it's especially this phase in life, clients just get bombarded with dinners and all these things. And annuities are some of the most complex financial instruments we deal with. Sometimes they make sense. Most times we can get around it and actually get better returns elsewhere. But it kind of comes back to the individual. How much risk can they take? How comfortable are they in the markets? And so you just really, really need to be careful because of all the times a client comes in, meets with me and like, this just isn't working. I thought I signed up for one thing. Off so many times it's an annuity or it's a life insurance product that they signed up for. They didn't understand, what was in it. And now they're stuck with surrender fees and low growth and all those things. So you got to be really, really careful with those.
There's a lot of different kinds of annuities, right? You have immediate annuities, you have variable annuities, fixed annuities, index fixed annuities. And so there's a lot of different kinds. And I know I've kind of put off doing a podcast specifically on annuities, and mainly it's because it might be a snore fest.
You wouldn't believe the amount of emails we got, people asking for annuity podcast. I'm just kidding. I don't think we've got one. So, yeah.
but yet they are sold a lot.
Yeah.
There are a lot of people that buy annuities, a lot of advisors that sell annuities, and we're licensed to sell them. We do use annuities when they make sense and when they're appropriate. But too frequently, it's one of those products that tends to get, in my opinion, overutilized for too many situations. And a lot of that is that unfortunately, a lot of the positives about annuities tend to get, I don't know if they're overemphasized or if that's just what sticks from the conversation into the client's head is the positives and they just kind of glance over the negatives. So I don't know where that's coming from necessarily, and I'm not going to make a judgment on that, but at some point we may want to do an annuity specific. But I think an interesting thing as far as pre-retirement and that phase and looking at income distributions, looking at buckets that we save in, that is a great time to evaluate to see if annuities are a good fit for you or not, to see if you meet the criteria to where they make sense. And again, I'm with Brandon to where the vast majority of the time, the answer is no, they don't make sense. And so for those that are listening, don't take this as, Rex said I should go, look at annuities and buy an annuity. That is not what I'm saying. And so I just want to be overly clear about that. But I do think that this is the stage of life that you should be evaluating that you should be becoming educated about the complexities of annuities, because insurance products just in general are some of the most sophisticated products that we deal with. And there's so many little gotchas inside of those to where, oh, we're going to pay you this distribution rate, but if your balance goes under this amount, then your distribution rate goes down to this. And that's in the fine print, right? And that's typically glanced over, and, oh, that'll never happen. Well, never is a big word, right? And I know it's, it's never and always are extremely big words. And so we've seen enough things throughout life that we don't want to use those.
Well, in this week alone, I was a client, they were sold an annuity years back, and she's like, I don't know, he just can't, like, he doesn't make sense. He can't tell me which, what to, and so I was looking at these options, and they were horrendous. Like, literally, you could invest in the S&P 500, but you had a 1.5% cap. You literally couldn't make more than 1.5% per year. Like, that's the worst term ever. Like,
but it was guaranteed.
No, it wasn't even guaranteed.
Oh.
I mean, I'm sure the floor was, right?
Yeah.
Yeah, but who cares? 1.5, I can get like 3 times that in a CD, and then the other there was another option where it didn't have a cap, so that was good, but then they only gave you 11% participation rate. So if the market did 10, you end up at 1.1%. I mean, those are the things that you've got to be looking at. Like, what are my sub-account options, and sure, it gives you market growth, but what is that market growth? If I can't go out and buy any fund out there, I have to use your select, 7 options that have pigeonholed me to where the point I won't be able to make any money. And so there's just so many little gotchas, like Rex said, that you got to be really careful.
We might need an annuity jargon podcast.
Oh,
right?
no, did I just go-
participation rates, sub-accounts.
Oh, no.
Right? I mean, but it's
Right.
true. There's so much jargon in insurance products, just in general. I mean, just in investments, in the investment world, there's a ton of jargon, but then you've got all this sub jargon, right? Inside of insurance products,
Fine print
products.
jargon.
Yeah, that very few people understand, or they may have an idea of what it means, a concept, but they may not still have a full understanding. And it's never been more important to understand what your money is doing, how it's working for you, what you're buying, what you're putting it into, what the purpose of it is, and where you're headed with it. And so it's extremely important to make sure that you understand. So if you don't, or you're concerned that you've heard jargon and you can regurgitate the jargon to me, but you have no idea what it means, then you should reach out. We should have a conversation.
Very good. All right. To wrap things up here, let's talk about long-term care or nursing home insurance. How can I make sure I'm taken care of in the event of an extended nursing home stay? I hear that's not cheap.
It's not.
Yeah.
It's so much so that it scared all the insurance companies. I mean, 10 years ago, there were actually quite a few companies offering a variety of products that were somewhat competitive. But what we've seen is that there are a lot fewer, dramatically fewer insurance companies that are still willing to issue that. Now, we can go out, we can get a policy, but they're expensive. They're really expensive. And just to clarify, so this is if you go into a nursing home, right, and you're unable to do so many daily habits, right, like dressing yourself or bathing or getting food or any of those things, then these kick in and they pay a certain amount out, right, so that you can help afford these facilities. But man, these policies are so expensive now. And so people will do, they'll buy a life insurance policy and attach a rider on with it. But the problem is a lot of these have some pretty low caps on the benefits, meaning that, yeah, you're covered, but we're only going to pay up to $50,000 of benefit or $100,000 of benefit, or, and relative to the premium that you're paying, most times it just doesn't make sense. Not always, but most times it doesn't make sense. And so what we're seeing a lot of now that these insurance companies have said, holy cow, this is expensive, I've gotten out, we're seeing a lot more clients just self-insuring, where you build up that retirement savings a little bit extra so that if a spouse were to go into a care facility or both of you go into a care facility, you can afford to cover that cost and continue the other retirement expenses.
Well, and again, that comes back to your distribution rates too, right? Because if all of a sudden you have an elevated distribution rate and at mid 80s, early 90s, you end up going into a long-term care facility, a skilled nursing facility, or a mental facility because of dementia or Alzheimer's or one of these terrible diseases, and you're in there for 5 or 6 years, and you did early high distribution rates, then all of a sudden we don't have the capital there in order to afford that. And so we spend down the capital, and then we end up going on government assistance. We end up utilizing Medicaid as opposed to Medicare. And sometimes those facilities, you don't get the same perks, right? Sometimes you're sharing a bedroom or sharing, TVs and maybe a different level of care than if you've planned for it in advance. And so that's, but again, I think that the sweet spot for evaluating that is pre-retirement. I still think the sweet spot of looking at quotes and looking at different insurance products to cover that versus self-insuring is still in that early 50s stage, because that's typically where you're going to get the lowest insurance cost, even though you're going to have it for a prolonged period of time. That's typically where that sweet spot is. And so I think it's important to evaluate and make a good, conscious, educated decision on what your plans are if you end up in a long-term care facility, or your spouse, or both of you, or if we're going to stay in our home and we're going to bring some care facility into our house, not care facility, but a care person that's doing either round-the-clock care or 8 hours a day care. And that gets extremely expensive when you start bringing somebody into your home for that kind of private care. And so we do want to make sure that, whatever your goal is, however you want to do that we've planned for that and we've looked at it. I know in an ideal world, right, most people want to live in their home as long as they can. They want to pass away in their sleep, in their own bed. And that's great. I hope that works out for you. Right. But chances are it doesn't work out quite as perfect as you hope. And so it's our job to help you plan for that.
And that's the purpose of that cushion in the financial planning, because sure, we can get on Medicaid, right? But before we do that, we have to drain all of the assets down almost to zero. And then, now we're on Medicaid, they're paying for one person's care, then they pass away. What does the surviving spouse do, right? They're left with nothing. Or what happens if one spouse passes away prematurely and all of a sudden we lose their Social Security benefit, and then we also lose the tax filing status. And so there's a lot of things that heading into retirement when we're in our 50s that we need to position such that, not only can we handle the planned retirement distributions, but also plan the what ifs of long-term care need, of premature death and things like that. And that's where all of this really comes together with a comprehensive plan, is we can look at, all right, where do we need to be at, account balance wise, cash flow wise. What about the what ifs? What if the markets perform really well, or what if they don't do well? What if we see inflation? And so pulling all of this together really is, I think, what helps people feel really confident going into retirement.
I think unfortunately what I see a little bit is people that have failed to plan, and they come to us in their mid 70s or early 80s, and they say, hey, my family member is saying that I should give them all my money, right? So that it's not my asset, it's now their asset, and then I don't have to spend it all down. And there's certainly people that kind of espouse that theory of disposing of your assets, more than 5 years. So it's not part of the Medicaid look back, and it's not part of that. And they try and game the system, if you will. And if you've planned for that in advance, then there's ways to do that aren't quite as risky or walking lines that maybe you're not comfortable walking. Whereas lots of times when you wait too late, then you're just taking an enormous chance, and it's just not worth that. Yeah. So.
Okay, so Rex, Brandon, thanks so much for hanging out with us on this episode of Through the Pines. If you thought this was good, we have more. So there are more Through the Pines podcasts. Go ahead and search Through the Pines on YouTube or your favorite podcast app. Also, you can follow us on our Facebook page at Through the Pines, and our Instagram. I know it's weird. It's called Through the Pines on Instagram. I think it's Pines_podcast on Instagram. So thanks for being here today. Again, you can find Brandon and Rex at planwithbaxter.com. That's planwithbaxter.com, BAXTER. This is it for this episode of Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.